The government has scripted a massive success with the Oil India OFS, and now it's all set for the big daddy of them all, NTPC, on Thursday. Clearly, PSU stake sales seem to have finally taken off after much dithering. Good news for the markets and also for the economy, given how critical a component divestment is for the FM's bid to get his fiscal house in order. So are things going according to the script, and what's the road ahead looking like both for the divestment agenda and the fiscal consolidation effort of the government? That's our debate tonight on We Mean Business. And joining us on the show, Mr. Prithvi Haldia, MD of Prime Database, on a link from New Delhi. Ashok Kumar Jha, former Finance Secretary, also joins in from our New Delhi studios. So does Sheshadri Chari, National Executive Member of the BJP. Sandeep Naik, ED and CEO, Centrum Broking, joins in on a link from Mumbai, and Dr. D.K. Joshi, Chief Economist at Crisil, also joins in from Mumbai. But before we begin our debate, let's quickly get across to Sapna Das to understand what transpired at the EGOM to decide on NTPC's sale next week. Sapna.
Well, no doubt, the NTPC issue coming out on the 7th of February, that is Thursday, will be the single largest offer for sale that the government is actually putting out in the current financial. And if it sails through, and that exactly is the expectation, the government's divestment tally will actually cross 20,000 crores. We all know that the government has been following a policy of giving discounts on all its divestment issues. NMDC, which has been the single largest so far before NTPC, had a discount rate of over 7%. And also the OIL issue that has gone through very recently had a discount of around 5.6%. So the question here is that what kind of a discount is being offered on the NTPC issue, and the likely pricing for around 148 rupees per share will also give them will give the government a revenue kitty of over 12,000 crores. So as the divestment secretary has rightly said, or rather rightly hoping for, that probably 12,000 crores is the rough estimate that they're looking out for in terms from the NTPC issue. The amount could actually be higher than that.
All right, with that, let's throw this discussion open to our panel. I want to begin with Mr. Prithvi Haldia. Sir, is all of this going according to script? There have been 4 issues till date. The government has managed to garner about 10,000 crore rupees. But of course, the target is 30,000 crore rupees. What's the sense you're getting?
Well, I don't think it is going according to the script at all. This target was set almost 11 months ago, and in the entire 10-month period, we have just had 3 offerings. NBCC actually happened in the last fiscal, so only 3 offerings have happened till now. And we are still very far away, 2/3 of the target is still to be met. NTPC is definitely the largest of them all, and in case it goes through successfully, then we would have made some progress towards realization of the target. Given the sense of the markets, well, we have seen in the past that the government is not very keen to enter markets when they are choppy or when they are volatile. And therefore, there could be, the remaining 8 or 9 issues which have obtained cabinet approval, whether they will be able to hit the market in the next 1.5 months or not, is going to be substantially dependent upon the market conditions. And therefore, I would keep my fingers crossed regarding the balance offerings. NTPC is imminent, it's just a couple of days ahead, and I think that may happen. But going forward, I think there could be issues in terms of being able to raise these kinds of monies in a short period of time. We have, every year we tend to club all the issuances towards the end of the year. The 12-month period is actually wasted. We have had reasonably good markets in the last 5-6 months. The issues could have been paced in a manner that, you could keep raising money every month. But all of this is again, almost come in the end last couple of months.
Right.
And although there is enough appetite in the marketplace, it's not to say that, there would be a lack of investors, but then you are stretching too far, especially in case the market conditions are not very good. And therefore, there could be concerns about raising the balance money.
Of course, the news today is that NTPC would be out on Thursday itself. With Sandeep Naik, would you agree with what Mr. Haldia is saying? Because to be fair to the government, they tried doing that. They came out with ONGC, and we all know what happened with that last month. Of course, there were 2 or 3 of them. Did the government really have a choice but to not cluster them, all of them together at this point in time when the markets are in fact looking up quite positively?
See, spacing out the issues is obviously the ideal thing to do, and when you have issues coming all through the year, it's good from a government perspective as well as the investors' perspective, and response would be much better. Having said that, I don't think anything is lost. We started the divestment program pretty late, though the target was set in the last year's budget. The program kicked off with probably Hindustan Copper coming pretty late in the day. But if you look at the context of how things have moved, and our current FM taking over sometime mid of the year after the old FM was elevated to the president's position, given that things really started to move in September, the 4 issuances that have happened, or the 3 issuances that have happened, has been a good achievement, including what happened in Oil India, where the subscription was almost 3 times what was on offer. So the appetite is clearly there. Yes, the timing should have been much better and much more spaced out. But I think the target of 30,000 crore is still within reach. I think so. 26,000 crores is certainly going to be possible, and that's the admission of the divestment secretary himself. But I think the big trump card that lies in the government's hand, which can be played very easily, is the Hindustan Zinc divestment. You have a Vedanta group ready with the check, and they've made an offer for Balco and Hindustan Zinc together. And if that goes through, you're looking at a number of maybe 17, 18, 20,000 crores, depending on where the government accepts the offer. Of course, it ran into a little bit of rough weather with the law ministry coming up and saying that there are some legal hurdles to getting into place. But with the budget session round the corner and the parliament assembling, you could clearly get those legal hurdles out of the way and go ahead with the divestment. It's in the government's hand. If that were to happen, you're looking at a number of maybe 40,000 crores, 30 to 40,000 crores. So I would say it's still not late. There is still 45 days, 60 days to go in the financial year.
Right.
And NTPC is just round the corner.
Mr. Haldia seems a little bit circumspect about whether the government is going to manage to get all of those issues through. Of course, Hindustan Zinc is not listed, at least for this year. But Mr. Haldia, before I go to the other panelists, just want to come back to you. Is the sense that you're getting this time around is that, the response has been from genuine investors? I mean, you've had a resounding success on the Oil India OFS. It's not, LIC and other proxy government investors who are bailing out the government in that sense. So is that heartening? Is that a positive at least?
Yeah, that's a positive, but that's a positive in the context of pricing. I think what I've been saying for a long time that government stocks should actually be sold to retail investors at a discount. That's the only way to increase the retail investor base, and you can return public wealth to public. What has been happening is that we have to offer these blue chip stocks. Most of them are really top of the line, at a price which is not necessarily the best price. That is the current market price, and therefore you have to benchmark your offer for sale at the current market price. But let me give you an example. I just pulled out some data. Now, if you look at Power Finance Corporation, it achieved the highest price of 383 rupees, and the offer was made finally at 203 rupees. If you look at NTPC, it has achieved the highest ever of 291 rupees, and currently you're looking at half the price, 152 rupees. So at 152 rupees, whether, so you are willing to, in a sense, get almost half the valuation that the company had, say 2 or 3 years ago. But when it comes to offering a 10 or a 15% discount to retail, which is notional, which is basically to anonymous investors, which could make the job of selling these issues very easy. You're not dependent upon the appetite or, hope for state government institutions to bail you out. I think one thing that we missed out completely, despite the government manifesto that every household should own a PSU share, we have done nothing in that respect all these years. And even the current disinvestment program is not even looking at retail at all. All these offers for sale, as we know, are substantially aimed at FIIs and domestic institutions. So I think one of the major objectives, while we appreciate the fact that disinvestment is necessary for better functioning of the enterprises, it is necessary for fiscal deficit, I think one of the major aims of this investment is also to enlarge the retail investors base, and I think that objective has been completely kept on the sideline. And in case we were to relook at our entire pricing policy and offer these shares to retail at large, and you could mobilize 2, 3, 4 crore investors, right. Especially now given RGESS, a scheme which is going to be launched officially in a couple of days' time. If these PSU shares were offered to retail investors, just on the strength of tax incentive, you will have millions of new investors coming in. So I think we need to relook at the methodology of selling these PSU companies and try to relook whether we can get retail investors in a big way.
Mr. Chari, is that a concern, the concern that Mr. Haldia raised about pricing, that the government probably may be selling out too cheap in a bid to sort of get its fiscal house in order, and that shouldn't be the primary aim really of divestment. The divestment should also go beyond just getting revenue in the short term, and you also need to get in retail investors. You need to sort of have a larger motive when you sell the house silver.
Just as Mr. Haldia was pointing out, what is happening is there are certain structural issues that this government has to tackle in the first place. The very high fiscal deficit, and most of the government spending is going on a non-profit issues. Most of them are non-profit and social sector oriented spending. So in the social sector oriented spending, what happens is the real investor does not come to the market to put the money in a place where he is not going to get enough return on his investment. The investor is looking at something like 18 to 20% return on their equity investment. But when it comes to getting something like 6 to 7% or 8% or even less than 8%, let us say, an investor would rather go to the bank and put 10%, 12% interest or even 9% interest without getting into this kind of an investment. So what happens is, as somebody pointed out, as I think Mr. Naik pointed out, that the market sentiment is very good, no doubt about it. But the market sentiment is not good enough to raise a kind of 30,000 crores, number one. Number two, what are you going to do with this 30,000 crores? If it is going back to schemes like Narega, etc., 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 where there is no profit earning, you cannot do anything. And in an election year, the government cannot really get that kind of money, and you cannot trust the government with this kind of money, 30,000 crores in the hands of the government, and if you are not going to get anything back out of it, I don't understand why the government wants to do this kind of exercise. And another important thing in the structural area is also the taxation laws. Right. So in this kind of a taxation structure,
points, but I just want to take that point forward to Mr. Ashok Kumar Jha. So the government doesn't really have a choice, does it? Because the finance minister has been harping on the fact that the fiscal deficit would be maintained at 5.3%, and he very badly needs this 30,000 crore rupees that would come in from the divestment front.
Well, I think firstly I haven't heard the earlier part of the discussion since I've just been plugged in. Now, you see, the issue really is that this 30,000 crores was a part of the budget, and this was a part of the budget which on the revenue side. So quite obviously the government is trying to ensure that the 30,000 crores as provided for in the budget is realized, and that is why the divestment program is going ahead full steam.
Right. Mr. Joshi, does this give you confidence? Does the way the divestment agenda is sort of shaping up give you confidence that the 5.3% fiscal deficit target would not be breached and that the finance minister is on the right track?
Well, I think it looks like that the 5.3% target is within reach. I mean, for two reasons. I mean, one, government is doing, or the finance ministry is doing what Mr. Kelkar had recommended. They are cutting down on expenditures. See, in a downturn which we are currently undergoing, economic downturn, the revenue position is bad, and clearly government the revenue collections have fallen. I mean, the target was a little over 22% growth in revenues, they're actually around 14%. But what government has managed to do is they have managed a sharper compression in expenditure. particularly planned expenditure. Now, I think, but that is not sufficient to ensure fiscal deficit at 5.3%. They need non-tax revenues, and divestment is one of the bigger components of non-tax revenues. And I think they've started late, but I think now the things are progressing well. We have seen SEBI come out with some of the guidelines which are investor friendly. So there is interest in these issues. So I think my sense is that I don't know whether the target will be met or not, but they will be quite close to that target. And I think on top of that, they'll also have to depend on other sources of non-tax revenues like the 2G auctions, which are scheduled for sometimes in March, I guess. So I think the government is trying to garner more revenues, at the same time also bringing in very strong expenditure compression. So I think overall looks like that they might be they might be closer to the target of 5.3% this year.
Right. Mr. Naik, let's really talk about what seems to be working as far as this whole sort of OFS, formula is concerned. Is it the discount factor that's worked, or is it the sort of tweaking in the norms that's worked? Because I think certain reports also seem to suggest that retail participation, especially in the Oil India OFS, hasn't been bad. Is that how it's going to also pan out for NTPC and the others that are going to be lined up soon?
Yeah, to start with, I think the success of Oil India has to do with both tweaking the offer for sale guidelines in terms of allowing FIIs to bid without actually paying the upfront margin, provided they don't have the option to withdraw the bid. So that is a very, very big positive for FIIs coming in, because they're able to apply through the custodian route where they can make a bid without paying upfront margin. Of course, they have conditions that they can't withdraw the bid or reduce the price. They could only up the bid in case they were to, basis the price being discovered, which will be shown online when a bidding is going on. That, along with the fact that there was a discount to market price. And there was a 5% almost discount to the market price, and the pricing was appropriate, coupled with the fact that certain measures that the government is taking in terms of taking off the subsidy burden from companies like ONGC, Oil India, where diesel prices would be hiked in a phased manner for 45 to 50 paisa every month going forward into the next 18-20 months. That sentiment was positive for Oil India, and that also related in contributing a great measure to its success. Now, coming to your other question on NTPC, and probably let me take the retail investor question prior to that. Of course, these issues are done through the stock exchange, and the time available to market these issues is maybe 24 to 36 hours, whereas retail investor is across the country in more than 300 cities. Reaching out to the retail investor through the OFS route is a tough exercise, and that is something which needs to fall into place. And unfortunately, retail participation in Oil India wasn't too great, and that is a little bit of a tragedy for India as a country, because you have the markets rocking every day. FI investment, you see investment of 1,000 crores coming in. And retail, in fact, is actually moving out of the market. You're seeing redemption pressures on mutual funds. But that is normally the story. Retail investors probably land up when everything is turned green and everything looks good, whereas the informed investor takes some calls and he's probably in before everything turns green. Right. So that is a little bit of a tragedy for the Indian retail investor, and that's something which the government needs to work, and us as intermediaries need to work on it. Right. As an investment advisor or as a stockbroker, it is equally my responsibility to go out and reach out to investors. But the time available, the window being contracted, it is tough to reach out to all retail investors, and that is something which is one needs to take into one's stride, because the sentiment is good and FIIs are willing to invest. So make hay while the sun shines. So if you wait for everything to turn and the retail investor to come, the sentiment may turn negative. Right now we had some good move with the market and positive territory, and FI investments are coming in, so one needs to take full advantage of this, and I commend the Finance Ministry for taking advantage. Though they started late, Oil India and NMDC have been good successes, and I'm sure NTPC, which is the largest power generating company in the country, will get a very good response from the FI segment.
Right. I just want to take that across to Mr. Haldia, sir. You know, what's the sense that you're getting on NTPC? I mean, you know, the thing with NTPC is it's a 12,000 crore rupee issue. So it's a big issue. And apart from, of course, the size, you have other problems surrounding the power sector. What's the sort of response you're expecting for NTPC? And do you think that, you know, there's appetite right now? Because what also seems to be happening in the markets is that there's some bit of consolidation, which probably could point towards the fact that people are staying out of the secondary markets to invest in issues like NTPC.
Well, I think, you know, there is enough appetite because appetite is actually a function of price. And if you're offering something at a discount to the market price, and the turnaround time for the investor could actually be 2 days, and he can actually sell out in 2 days, 5% profit in 2 days is not a bad deal. And therefore, I think 5% discount in a stable or a buoyant market. In a declining market, 5%. So basically, you converted, you know, the fundamental issue that I raised even earlier is that you converted good investment opportunity into arbitrage opportunities. You're basically looking at the difference you can offer to the large investors between the market price and the offer price. In case they find the difference is 4, 5, 6%, it makes sense for them to come in, put in money, hoping that the markets are not going to tank over the next 2, 3, 4 days, and they can exit at a profit of, you know, the difference between the market price and the offer price. These stocks, as I said earlier, could actually have been used to get investors rather than traders or arbitragers. And there, I think we have missed out completely. And one of the things that I've been proposing is, you know, this auction system that we are having today, which is an open auction system. You know, if you could work on another system, which is a closed auction, where you invite bids from institutional investors, say for 65% or 70% of the total issue size, and those bids are not disclosed to any other bidder. There is a floor price which is in a sealed envelope, and then you start allocating from top price downwards up to the point that you have reached the number of shares that you want to sell. We have seen that closed auction actually can get you better prices than the market price, because there is an institutional demand of a kind which will look at getting large quantities at a price even higher than the market price. We saw that even happen in the case of Oil India, where bids came much above the floor price. So there is a genuine demand from long-term investors to get large quantities of a listed stock at a price which is not necessarily the current market price or a discount to the current market price. Right. It could be a price which is even higher, and therefore the government could realize much larger sums of money by going through a closed auction method. Right. The remaining 20%, 25, 30%, just to conclude, just, you know, the balance 25% or 30% of the offer for sale could then be made into a retail offering at the lowest of the OFS price. So you are, and you could then keep that open for a day or 2 or 3 days, which is typical of an IPO, and you can get, you know, large number of retail investors into the market. So even the discount, additional discount that you have to offer to retail, even at the OFS base price or you know, the base price, the discount would be more than offset by the greater realization that you will get from the higher bids that you will get from the institutional portion, and at the same time you will be able to attract a large number of small investors. So I think what we have done is basically we have converted this entire auction system into an arbitrage system where right. large investors would come on the strength of a 5% discount, put in money, and then just walk out.
Right. You know, Ashok Kumar Jha, would you agree with that? You know, that there's possibly a need to recalibrate the strategy on this sort of entire OFS thing that the government has been going on about. You know, there's a distinct change clearly in its divestment strategy. You come out quickly pushing through small lots. There's no big announcements, no sort of road shows done, and the retail investor largely gets ignored in all of this.
See, pricing is really the key in this whole disinvestment or whenever you're trying to sell shares. Now the past experience of the government when it was the ONGC sale a few months ago, where the price that was indicated was probably a little too aggressive, and therefore the entire issue really had a problem in selling, and LIC had to come in. The only way of getting a sale off properly is to price the issue slightly below the market price, which is what I think the government has been doing. Now the question really is that, I mean, one can easily argue and say that, you know, why not you put it at market price or little higher than the market price, people will still buy those scrips. But that I think is using the hindsight more than foresight. Because if you price it at market price, why will people go and buy right now? Why, it's basically a question of something must be left on the table for the investor, whether it is a retail investor or an institutional investor, and that is the only way that you can really do a proper successful disinvestment. So I think the government has really gone in for pricing it more competitively this time around, and trying to avoid the pitfalls that occurred when the ONGC scrip was disinvested.
Right.
So it's I think putting the pricing slightly below market price is really the solution, because you have to put something on the table for the investor.
Right. Mr. Shadi Chari, do you agree with that? Just a 5% discount? I mean, does a lot more need to be done from the government side to get the retail investor back on the table and actually benefit from all of these companies which are, in some sense owned by you and I? These can't just be used by the government to bridge its fiscal shortfalls.
Yeah, certainly. The question here is not whether it is going to benefit the retail investor to some extent or not. I think we are still not addressing the real issue. I would still agree that the entire disinvestment scheme would probably be a successful run, but not in the short term. Like, you cannot expect this to happen in the next 8 or 10 days or 12 days, 15 days, because most important is the market sentiment. Even for the retail investor, he is not going to take any decision today with a budget just 2 weeks away from now. And moreover, this is an election year, don't forget that. So before, even if the institutional investors are always ready to put in their money and realize something out of it, but the real investor or the short-term investor or the retail investor is not going to go into the market as of today, because the market sentiments, if you look at the market sentiments, they are not really good. There is not enough confidence in this government. There is not enough confidence in the government's way of tackling the fiscal deficit. The current account deficit is also very high. The government has not really done anything even in the current account deficit issue.
Let's talk a little bit more about that. And I want to get in, Mr. Joshi.
The most important element in this agenda is in the short run, this agenda may succeed. Instead of 30,000 crores, the government may get, say, let us say 20 to 25,000 crores. But the real issue is, what is the ultimate purpose that the government is going to serve? And if that purpose is not going to be served, then what is the use of disinvestment now?
Absolutely, sir. In fact, Mr. Joshi, I want to get you in. Fitch yesterday came out with a note saying that they want to see fiscal consolidation, credible fiscal consolidation, not just in the short term, but really in the medium term. And they're worried about how it will pan out in the medium term, whether there's a strategy. Now, beyond divestment, does the government also really need to look at, other important, means of getting its fiscal act in order? I mean, you have the elections, you have lots of, other companies that are going to be hitting the market through the OFS route to meet the sort of SEBI shareholding norms. And like Mr. Haldia did mention, maybe, the divestment momentum will not continue. Does the government then need to look at other means, like, for instance, exiting its investments in Suti or monetizing land banks? Do we need sort of more creative ideas then for fiscal consolidation?
Absolutely. I think, see, the divestment, etc. is one-off. I mean, you cannot depend on divestment for your medium-term sustainability of public finances. I think here I'll just like to draw parallel to what Mr. Chidambaram did during mid-2000. I mean, when he brought the fiscal deficit down to 2.7% of GDP. I think at that time this was the rising tide effect of very high growth. I think the revenues were very good and you could manage to lower your fiscal deficit even without cutting expenditures. There were virtually no expenditure reform at that time. Now the situation is quite different. I mean, the days of 9% growth are not visible in the near term. So with a slightly lower growth, India being on a lower growth trajectory, I think it has to depend on expenditure reforms. I think expenditure rationalization will be very critical. And I think the steps that government seems to be taking as of now are steps in the right direction, because they are trying to get rid of subsidies. They're trying to bring the overall expenditure down. I think what they also need to do, which they haven't done until now, is to move the expenditure away from revenue side to the capital expenditure side. I think the fiscal correction that we are currently seeing is relying more on compression of capital expenditure than of revenue expenditure, because revenue expenditure, because of the subsidy, bloated subsidy bill, cannot be brought under control. So I think from medium term fiscal sustainability in the scenario that we are in the growth scenario that we are in, I think expenditure reforms will be very critical, and I think there come in steps like rationalizing fuel subsidies, fertilizer subsidies, even food subsidy. So I think those are the things which we will have to depend on. And I think if you want to accelerate the pace of fiscal correction, then I think the using land banks, etc., which Kelkar committee had also suggested, I think that can be resorted to.
Right. Mr. Haldia, net, how do you see the sort of divestment momentum panning out from here? I mean, you have, I think, MMTC, RCF, Neyveli Lignite, SAIL, all of them lined up before 31st of March. But you also have, like I did mention, a rush of paper that would be coming in to meet the SEBI deadline of June, I think, for the shareholding norms. Given all of this, what's your sense? Should the government be a part of this mad scramble, or should they wait it out, phase it out, and maybe, not use divestment really as a sort of big, tool through which they finance their fiscal deficit?
Yeah, before I come to that, a small point that I wanted to mention was that when I was seeing closed auction, and the point that was made by Mr. Jha, that why should a retail investor bid at a price higher than the market price? Well, we've seen historically, and one of the best examples is Maruti, where closed auction actually got you bids higher than the market price, because if you place an order for a very large quantity in the market today, in the secondary market, you will not be able to either get the quantities or the prices would go haywire. And therefore, there is an assurance of a large quantity at a higher than the market price if you are willing to bid aggressively. And therefore, I think that closed auction is probably a better way going forward, along with the retail, which has been desperate to invest, which has only been going into gold and real estate and has not found any avenues for equity. And if you're looking at long-term investment, enlarging the investor base, I think we need to really seriously rethink about the divestment program. Coming on whether, what's the future of divestment, I just pulled out a list from my database. There are 112 PSUs today in our pending list, which have announced at some point of time that they would enter the market with either a IPO or an FPO or an offer for sale. So the pipeline is very strong, and we should remember that all these companies are basically profit-making companies, because no loss-making PSU would ever hit the market. And so these are some of the better companies in the PSU stable. The pipeline is strong, but as we have seen in the last couple of years, and I only hope that the situation will now reverse, but in the last 2 years we have seen that we have got, for example, today we are sitting with 11 CCEA approvals, where the cabinet has approved the divestment, but only NTPC is currently in some advanced stage. The remaining 10 we don't even know when they are going to happen. And they can get deferred for a variety of reasons, including ministerial objections, including the markets not giving you the price that you think you should get. And therefore, I am not very sure right now that the divestment program, unless it is rethought and relooked, could be a major avenue for raising funds in this year or even in the next financial year.
Right. Sandeep Naik, very quickly, because we are running out of time. Also, the other important question is, are equity markets going to be conducive enough in 2014, in FY14, I beg your pardon, for the government to sell stake in many of these companies, because we're already reaching life highs on the indices?
See, I think so. Markets are conducive. If you look at what has happened in the last 6 months, you've seen a good FII flows coming in. In fact, even in the month of January, we've had almost 20,000 crores of money coming in into secondary markets. So the sentiment is positive. Now, when you look at the big picture from a person who's sitting in the markets, a very important need for us as a country is to attract foreign capital, both in the form of FI investments and FDI. And FI investments are going to come if government walks the talk. I mean, if you had set a target of 30,000 crores for divestment, it might look to be an innocuous number. 30,000 crores that comes from the divestment is not a very substantial sum of money when you look at the Indian government's overall budget. but it's important to hit this number and signal that you mean business and you're willing to walk the talk. And that itself will fuel more monies to come into the country in the form of FI investments. And if FI investments come in, obviously market sentiment is going to remain positive, markets will move up, and you can bring in more of your issuances. And today you may have only lined up 10, and like Mr. Haldia mentioned, there are about 122 companies that have at some point in time expressed their desire to divest. And I think so one should not be worried about these few equity issuances going at a discount to market price, a 5% discount to market price. And this 30,000 crores, if is successfully put through, you got another 120 companies to divest, and India has assets to divest and cut down its fiscal deficit.
Right.
It's unlike the West,
you
where
did
there are
mention
only
the
problems and no solutions.
Right, you did mention the FIs, but there are going to be a lot of variables on.
At least we have the assets to sell.
Like, a lot of variables on which that would depend, whether the FI inflows continue to remain that strong in FI14. So really, whether the markets will have the appetite for all of these issues will remain a big question. But Mr. Jha, at the end of it all, forget 2013. What do you think is going to be the target of the government for divestment then in FY14? And is the FM going to be more prudent in setting it, given what's happened this year? Because he will have to go ahead and do it, given that the target for fiscal deficit next year is even lower. It's 4.8.
See, the previous financial year, the divestment target was 40,000 crores. And the achievement was almost negligible. So that is why in the current financial year the target was reduced to 30,000 crores, and all indications are that the target will be achieved. So now, as to what the target is going to be next year will really depend upon when the Finance Ministry tots up all the revenues that they expect from different sources and all the possible avenues of expenditure, and see what is the gap. That will really determine the target. It's actually pointless for us to speculate as to what the target will be. But I think one thing is for sure, that whatever is the target this year, that is 30,000 crores, to my mind looks as though it's going to be achieved before 31st March this year.
All right, so we're completely out of time. Would have loved to get more questions, but clearly lots of action on the divestment front then, and we'll have to see if the success of Oil India would be replicated, at least with NTPC, which hits the markets on Thursday. Really all eyes would be on that big 12,000 crore rupee issue. A big thank you to all our guests for sharing their perspectives. We'll have to take a quick break at this point. We'll come back though with speed news on the other side. Stay tuned.